very warm welcome to this webinar, The Virus of Financial Deregulation. This webinar comes at the right time. Just today, the high-level expert group of the European Union published its report on the Capital Markets Union, and yesterday, the European Parliament voted a package of financial banking regulation, and we see a common pattern evolving. The coronavirus is not limited to human bodies, but it is spreading, unfortunately, also to the banking system and the financial system. Old recipes that lowering capital requirements and so-called regulatory burden would be the right recipe to help the real economy or consumers in moments of crisis. And this is the reason for the Green Econ team to organize this conference and to discuss this worrying tendency. The Green Econ team of this period is, of course, Ernest Urtasun, Claude, Gruffat, Stasys, Jakeliunas, our big boss, Philippe Lamberts, the co-spokesperson of the Green Group, Peter-Hansen, and myself, Sven Giegold. And this webinar will be running in 5 languages. You can choose your language at the bottom of the Zoom window. Open the Zoom window completely to see the function translation, and there you can choose from English, German, French, Spanish, and oddly enough, Korean. But Korean is not Korean, it is Italian. Unfortunately, Zoom doesn't offer Italian, so we had to choose the remotest of all the options, and that's Korean. So sorry to Italy, we know it's a sensitive issue for you. So you can follow all the discussions in the different languages. Of course, this webinar is also for you. So you can answer your questions in writing using the Q&A, F&A function. You can also raise your hand if you want to speak into the microphone by pushing the hand button. And on top of that, it is very important for everyone to speak slowly, clearly, and as structured as possible so that the translation can follow. And lastly, I have to stress that this webinar will be recorded and it is transmitted in parallel on YouTube, so that you should be aware if you ask a question that what you will be saying will be available in public later. Bonjour, Nicolas. And we have really distinguished speakers here who Ernest will introduce in a moment, and it's structured according to several panels. This webinar came obviously at the right time because we have received nearly 900 registrations and more people coming in all the time. And the reason is very clear. While officially with the reforms of Basel and the reforms of the Financial Stability Board, financial regulation was stepped up, we saw a parallel tendency starting already in 2016 of targeted deregulation. So in particular, in the European system, the split in Pillar 2 banking regulation between Pillar 2 capital requirement and capital guidance implemented 2016 reduced the effective capital demanded by the largest banks by about 10%. On top of that, we saw that in 2019, with the introduction of the 5th Capital Requirement Directive, it was possible for banks to fulfill Pillar 2 requirements also by 81 instruments, which reduced by another 10% the CET1, so the hard banking capital. So freeing up about 100 billion of CET1, so hard capital, for the ECB controlled banks. Furthermore, we see now this year a whole bundle of new deregulatory measures, first on the level of the supervisors. So, for instance, the full use of the buffers, including the Pillar 2 guidance to operate below the liquidity coverage ratio, and front-loading of some of the AT1 eligibility for the Pillar 2 requirements. So basically, introductions, an earlier introduction of what has been decided already the year before, which frees up about 120 billion of hard banking capital. And now just voted in the European Parliament and be against our votes, obviously, and with at the same time being negotiated with the Council is a whole package of reductions of what is being asked by the banks. Worryingly, the European Commission withstand a lot of the lobby requests by the financial sector. They came with a comparably limited list of deregulations, but this didn't stop the different main groups in the parliament to each demand additional deregulation, which the Council now voluntarily agreed. And why we are seeing this in the field of banking, we have the same tendency now with the Commission asking for deregulation measures when it comes to pieces like MiFID and PRIPS and other pieces of financial law. I don't want to get more technical. Politically, this means that the belief, if you reduce capital demanded by the banks, it will lead to higher lending to the real economy in a moment of crisis. This belief is exactly the prudential stimulus, which has in the end led to the big crisis of 2007, 2008. The alternative to give more equity to the banks with conditions, for instance, to fund the real economy, the sustainable transformation of our economies, is of course less agreeable for those who own the banks today. And therefore, this obvious alternative was not chosen. But instead, we are now faced with a new wave of deregulation. And this is why the Green Econ team wants to bring together these distinguished speakers to listen to the views on these developments from different perspectives: academia, think tanks, investor and consumer protection, NGOs, to rethink whether we need a new coalition in order to fight back this new wave of deregulation, knowing that the old wave of deregulation starting in the 1970s until the big financial crisis 2007 has brought so much hardship to everyone. So, and now I'm looking forward to this debate. Thanks to everybody who contributed to prepare this event. And I hope it will be the starting point of a civil society and academia and politically driven counter voice to all those who want to deregulate again. Please, Ernest.
Thank you so much, Sven, and thank you so much to everybody who has joined us to discuss this important issue. As Sven was saying, we are fearing that we're entering a new phase of deregulation. We just had, as Sven explained, the quick fix of the CRR that was already adopted at the level of the Econ Committee, where we had the first round of deregulating measures, but more things are announced. And particularly, it has already been announced, because this has been pushed by the financial sector, that probably MiFID will be also entering the phase of revision. So all this makes us fear that we will, with the excuse of the commit, we will probably enter a new phase of deregulation. And the intention of that webinar was to have together experts in order to get really into the matter and to the details to see where the dangers lie. So without further delay, I would like to introduce the three first speakers that will be addressing this webinar. Firstly, for an introduction, we will have Anat Admati. Thank you so much for being with us. Anat Admati is Professor of Finance and Economics at Stanford University and author of the book Bankers' New Clothes, What's Wrong with Banking and What to Do About It. She will be doing the introduction to this webinar, and immediately after we'll jump to an experts panel with two speakers. Firstly, to discuss about the CRR quick fix and the changes of supervision, we'll have with us Nicolas Véron. Thank you so much for being with us, a senior fellow Bruegel and Peterson Institute for International Economics. And finally, in this first panel, to discuss about financial regulation and consumer protection, we will have with us Thierry Philipponnat, Head of Research and Advocacy at FinanceWatch. Thank you so much as well for being with us. So without further delay, I will give immediately the floor to Anat Admati for an introduction to this very interesting discussion. Thank you. The floor is yours.
Okay. Thank you. I will, sorry about the phone. Thank you for this, and thank you for including me here. I'm going to try to give you a brief overview of what is going on and the regulations that we came into this current crisis with, and what's wrong with them and where we are right now in terms of the discussion. And I'll touch on a number of the things that Sven brought up. So I start with the big picture that I present when I teach finance and society at Stanford, showing financial institutions and markets. I show them as very strong and muscular here. Governments and their institutions, people in the middle, of course, and the rest of the economy, real economy. Now, this picture is missing an increasingly important set of players, and those are the central banks. So central banks are very unusual elements of the system, increasingly important, and they will come into play because they're kind of lying in between the financial sector and the government. So we will see them show up, ECB, the Federal Reserve, etc. They are important, and you'll understand why, because I'll try to teach you a little bit. So starting with the last crisis, the one that got my attention on banking, that was a headline, September 15th, 2008, almost 12 years ago. And central banks, the Fed and the US Treasury, and then central banks and governments all over, did extraordinary things then, and now they're doing some of the same things again. And then the regulation will come into this as well. So that was that crisis, and they propped up the system in incredible ways. And of course, we have the history of the decade since then. There were a lot of narratives about financial crisis. This, of course, one is that we are in right now, not a financial crisis yet, but a public health crisis, is a pandemic, economic crisis related to the pandemic. We'll get to that at the end. But, you know, the crisis was viewed by some, or wanted to be presented by some, as a natural disaster, as something about the plumbing, liquidity problems, as they run, and all of that invoked the notion of sending the ambulances and all of that. This is a JP Morgan Chase CEO who said that he told his daughter when she came from school and asked him what is a financial crisis, that basically it's something that happens every so often, is what he told her. So the idea was, you know, don't worry about it. Every 3, 5, 7, 10 years, we have a crisis. When I was giving talks about the decade from the crisis in the last 2 years, I was always saying, okay, so where is it going to come from next? I don't need to ask that question now, because we know where it would come from next, if it comes. But here's the question I want to ask. Are financial crises preventable? Okay, I will have a simple answer to that. Is the financial system working well as long as there's no crisis? Is everything okay just between those crises and we're fine? And why does financial regulation keep failing? Because my answer is going to be yes to the first question, no to the second question. It's not working well all the time. And then occasionally it shows how bad it is when it it near implodes or implodes. So there's something wrong with the system all the time, and the crises are just when we see it or when we worry about it more. So you might think about it as a car accident. Car accidents happen, and then you might think about the speed limits that we might put on to try to prevent them. And so maybe we can't prevent all of them, etc. It's sort of in the space of rules and in the space of these things that can happen and the shocks that can shatter the system, which is sort of the space we're in. Just to answer about the last financial crisis, my view is in complete agreement with the basic executive summary of the Inquiry Commission in the US that actually came only in January 2011, which said basically that the crisis was avoidable, that it reflected widespread failure of financial regulation, that it was a breakdown in corporate governance and explosive and excessive borrowing, lack of transparency. All these things will come into my discussion. Widespread breaches in accountability at all levels, meaning the institutions themselves and the government institutions. So it reflected distorted incentives everywhere and failure of rules and governance. I am going to just post here, just as the biggest picture, what is it that the financial system is meant to do for us? It facilitates a very important system, a sort of infrastructure. It facilitates transaction payments that we make. It allocates savings and investments and supposed to facilitate the risk sharing so that we can optimally, make investments that help all of us. And it helps sort of the governance and what gets done over time through investor voices or other things like that. The challenge in finance is that this system is really fraught with a lot of conflicts of interest and power differential and information differential, including about the discussion about regulation. In other words, where the expertise gap and the knowledge gap between the public being affected by this system and the decision makers in this system throughout this system. One of the issues is debt, and so I'm going to come to the words that already were mentioned, capital and liquidity and all this stuff, but let's talk first about debt, because that is the fuel of a lot of what, our growth consists of. It's done through this wonderful contract of debt, which is IOU. One of the places where we meet it frequently is home ownership and mortgages. So I'm drawing here in color debt, which is like the mortgage that you have on the house, and the equity, the original amount you put in, which fluctuates with the value of the house. If you sold it, what you'd have left. And just drawing very quickly, if you bought a house for $400,000 and paid $20,000 in down payment and the rest you borrowed, here is ignoring interest and other things, what happens when the house price goes up. You owe the same amount, or with interest. I'm not really complicating the matter, but all the increase of 2.5% the value of the house actually gave you a 50% increase in your equity portion of it. So in percentage-wise, it's great on the small base. If the house went up by 5%, you double your $20,000 because you benefit from the entire gain. So it juices up, it magnifies the returns on the upside. The house goes up by 10%. That is the $40,000 that now gets added to the $20,000. So you tripled your initial money. So this works really wonderful. Debt magnifies the upside. You put a little bit of money and you get to do a lot more. Buy a big house. However, it looks very ugly on the downside. So if there's a small decrease in the value of the house in this case, of course, could also be reasons that you will not be able to pay your debt. That's a different thing because you lost your job or whatever. So all the promises that we make. But here is just the value of the house against which you borrowed. You lost half your equity for just a small decline in the value of the house. This was sort of the subprime crisis in the US. 20,000, 5% decrease in the value of the house wipes out your mortgage. And this is a situation called being underwater, which means that the house is worth $280, but the house is worth, $360. And you owe $380, so you are underwater, meaning if you sold the house, you couldn't pay your debt. So that is going to be akin to insolvency for corporations. Now let's talk about banks. Banks have deposits, which is colored red. Everybody forgets that, but they do owe us back the money. It just doesn't feel to it as it to them, and I'll come to that in a second. And we can take that money that they owe us anytime we want in the ATM, so we count on that. But they build a big tower of red debt that they owe, And of course, they might put it at risk, and what happens if they lose? So they put a teeny bit of equity under this. And of course, here's what can happen should they lose. What can happen, since they're very interconnected, is they will start a contagion mechanism, which, you know, is dominoes of some sort through the contractual relations they have with one another, and through other mechanisms of panic and fear and whatever else. And here we have a financial crisis, and here we have, this is Uncle Sam, governments and central banks and people standing behind them, propping up the system and trying to save us from it collapsing. And that was basically, in a few minutes, what we have experienced sort of a decade ago, and, you know, way back in the history. But here's what happens now, color-wise. In the codes, I come from Silicon Valley, and here in the big tech companies, they don't bother to borrow. They just have a lot of profits, and they mostly fund with equity here, and they don't need to borrow now. They don't have a business of providing liquidity and deposits, but still the difference is so stark. What is wrong with Google that it has so much equity? Why is it having this equity that the banks say is so expensive to have, and all of that? Now, I want to stop and mention that when you talk about things like balance sheets, I didn't draw it, I just color-coded sort of assets and liabilities. Central banks are very different. Central banks are not normal corporations. They don't have normal balance sheets. People talk about their balance sheets, but they just can make it. So they print that currency, the paper money of central bank money that we used to pay. And that is very special because the central bank is not going to default on the currency. It can print more of it. So this is a very unusual institution. It's not a private corporation. However, anything else we could think about as this loaded word money is somebody's debt. Our deposits, our credit cards, everything we use, there's somewhere somebody owes somebody something. And the economy is built on IOUs. So central banks are special, but the rest of us build that. Now, I will summarize to you this big debate that I've been involved in for more than a decade now about equity for banking, the green stuff, okay? The bottom line on this green stuff is that the banks hate it, and have as little of it as possible. So they want to only make investments on money that they owe somebody, which they will not default because somebody will prevent their default, the central banks or the government. And they meanwhile can take that upside that's magnified. And so they get compensated to gamble, and they get tax subsidies and others, and they can shift the costs and risks to other people. And so it's pretty clear from their perspective why they hate equity. They have a particular way in which their creditors, including depositors, are very easy on them, and therefore they can do it. From society's perspective, the fact that the banks have so little equity by historical standards or by any standards you can think about, and nothing to justify that, is just that is bad. And so there's nothing good about it at the levels that we have it, which is really outrageously inadequate levels. And then there's the measurement issues I'll get to. But everything good can happen if they just have more equity funding, more green stuff to do all the stuff they need to do, support the economy. Everything they do will be better. The liquidity they provide will be safer. They won't need as much support. They'll make fewer bad decisions, all of that. So I need to introduce you to the concept that's very important in the whole discussion of corporate debt, even small business debt, the concept of a zombie, the concept of insolvency. It's sort of like the underwater homeowner. It's a very tricky thing to identify when somebody is a zombie, because you can default on your debt, but maybe you're insolvent, and that's a much trickier thing as long as you pay your debt, which is sort of the permanent state of banking, is sort of high distress or insolvency, a big overhang of debt. So there are symptoms. This says don't open, dead inside. And this is important. I'm not showing you zombies because very unpleasant to see zombies, but they have symptoms. A zombie institution, a corporation that can issue equity, cannot find people to give it equity if it issues a piece of paper called equity shares. People don't want to give it because it's very weak and the debt will have to be paid and there won't be enough left. they start having a lot of biases in favor of taking a lot of risk, because the upside they can take and the downside they just walk away from in bankruptcy or whatever, or somebody comes in to help them. They're anxious to take the cash out, which is to pay it out to themselves, to the managers, to the shareholders. They avoid equity if they can possibly lobby against it. They sell assets even at fire sale prices. I've done a lot of research on the responses to all kinds of ratio requirements and other things. It's all technical, as was said, but it's not that hard if you get there. And they hate the boring projects, because the boring projects go to the creditors and they will underinvest in those business loans in favor of all kinds of other things, depending on the regulation, depending on all kinds of things. And they try to hide it in their disclosures to just live another day and lobby the policymakers to just keep persisting in this unhealthy state. Here's a study from just over a year ago about zombie firms. So companies that are very weak, have a lot of, and they produce non-performing loans that are not paying the banks, and their connections to weak banks. So the zombie banks tend to keep alive zombie inefficient institutions and even crowd out some healthier business that they should have funded. So that these investments get very distorted and the system is not producing what we want when we have a lot of zombie banks and a lot of institutions that are really not viable throughout the economy. And it can really harm growth, it can cause recession, all of that. So a lot of that overhang is not good. Now, the regulations that are supposed to take care of it are written up in Basel, in the Basel Committee for Bank Supervision. And the Basel II, with which we entered the last financial crisis, was a spectacular failure. And I can go on and on that. And the Basel III that's supposed to save us is barely a tweak. And maybe one quote on it is a well-intended illusion. So they trick you into thinking, oh, it's so much better. We did so much. We tweaked, this screw and that screw. Bottom line is it's really a disastrous reform, however much it's a little bit of a reform. And I'll just illustrate it with one example of the Greek crisis, which has its own points, because this bad regulation matters a lot to people. And it mattered a lot to the people of Greece, as well as to the people of the lender countries, which were, as you can see in this graph, the citizens ultimately of France and Germany in particular, whose banks were the lenders to Greece. So what you can see here is who lent to the Greek government, which was like a subprime homeowner, not a very prudent borrower, but we have to ask who the lenders were. The lenders were the private banks in France and Germany primarily, and in lots of other countries. In 2009, the Swiss banks left, sold all their Greek government bonds, but the French and other banks stayed there. And in between, when Greece was finally allowed to restructure and default on a little bit of its debt, there were multiple bailouts. What that meant was that Greece was being given money so that it can pay back its debt to the French and German banks and other creditors at high interest rates, so that we won't have more failures of French and German banks, because then we'd have to bail them out, and we just finished bailing them out. So we rolled into a crisis in which the hidden bailouts were really supposedly given to the lazy Greeks that borrowed too much, but in fact went to the reckless institutions to a large degree for a while, which made those bad loans and didn't absorb the losses. So the French banks owned 40% of the Greek government debt in 2010, and the regulation, this same regulation that Basel devised, are counting lending to governments in Europe as if it's riskless. It gives it zero risk weights, which means that you can't ignore it as if it was good as cash. So that's how crazy this gets, is that the regulation decides what's risky and what's not risky. And if it decided that it's not risky, then suddenly you can ignore the risk. And you can lend as much as you want and get all this spread that you can get. So in 2015, when we entered a very intense summer of almost having Grexit, who owned the Greek government bond? Well, in blue here, you see the citizens of Europe, meaning the German citizens, not in green the German banks, and certainly not the French banks, which were all pretty much out, but in the bailout funds of the European bailout the total fund that ended up buying all this debt and assuming all this debt, countries contributed based on their size. And these were countries that were already had troubles in some cases, like Italy, that suddenly had to bear the risk of Greece default. And of course, two institutions, IMF and ECB, that also took on some of this debt. And that ended up, the Troika, the official creditors of Greece, ended up being very, very harsh on Greece. And we know that that was caused a major depression in Greece and all kinds of conditions. And which was a big crisis, okay, which we're sort of not hearing about as much in the news. Now, they'll tell you also in the regulation, so I need to go quickly here, that they created a clever bail-in. So instead of bail-out, we're going to have bail-in. The problem is they don't press that right button that some of them would tell you they have to cause the investors, meaning the creditors, to suddenly lose. Not the shareholders who automatically lose when there's a loss, but they will trigger some bail-in, except for the problem that they just don't. So here's January of this year, and governments in Europe are still finding workarounds to bail out their banks. So again, either you sold the bail-in debt to somebody, you know, a retail investor in Italy, and they're going to kill themselves because they didn't realize that they were supposed to absorb losses of, you know, Monte dei Paschi or some other sick bank. But somehow the governments don't like to let the banks fail or their investors to lose because somebody is going to lose. And so they choose that's yellow button, the smiley face save button. That's what they always choose in the end. Now, this is a paper from 2018. I'm moving to the fact that we don't even know what's inside the bank. So that's the don't open debt inside, because the disclosures are so poor. This is a 2018 paper that says that we can't even estimate the indebtedness, the leverage of the banks. Off-balance sheet funding that's not even reported well, that's not even counted as much, is higher now than in 2007, before the other financial crisis. And this is a recent paper from IMF, okay? Here's a headline from just 6 months ago, December 18th, okay? Wall Street magic tricks make banks look safer than they are. Accounting tricks. Numerous tricks are fooling us into thinking that the banks are so much better and so much stronger. And I don't believe that. There is a lot of innovation in banking, but many of them are in order to evade regulation. So here's a cartoon for you. These new rules will fundamentally change the way we get around them. So there are numerous ways to create a really complicated system that kind of hides the risk from the regulators and from all of us in huge chains of shell corporations, subsidiaries, securitization vehicles, you name it, credit default swaps and other shadow banks and all this stuff. So why are we here? This is Alice in Wonderland. I'm going to end up with the Emperor's New Clothes. We're here because there's just so much nonsense that people say in this space. So the rabbit hole is where things you think you're going to go mad from all the nonsense. Here is the nonsense for all of us that came out after our book, where we debunk a lot of nonsense. Because we have substantial self-funding with consumer deposit, this is the CEO, ex-CEO, 2 CEOs ago, of my bank, where my money still is. He says, because we have a lot of deposits, we don't have a lot of debt. Remember, the deposits were colored red. He owes the money. So here's the CEO of my bank forgetting that he owes me the money. And this gives you a notion of the way the bankers think, because deposit money to them is just like play money. So he doesn't think of it as a debt because it doesn't feel like debt to him, because I don't behave like a creditor, because I trust that the regulators will take care of my deposit money and that it won't be put to excessive risk. What if they fail, though? So now that we get to the word capital, which I haven't mentioned yet, but here it is, okay? So the way it's used is a very loaded word. It's used in economics in all kinds of ways: capitalism, capital-intensive industries, all of that. Here's a piece of news in Financial Times. And Financial Times is a sophisticated newspaper. They're holding capital Okay, the Telegraph will say they're holding cash. Now, the word cash, we know, the only problem is that this piece of news from 2014 is actually false factually. That is not what was decided, that the banks have to hold, like in a safe deposit box. This is green stuff that funds investment. It's a source of funding, equity funding, unborrowed money. But the lobbyists love this confusion about which side of a balance sheet, whether you're talking about what you invest in or how you fund your investment. And they can say every dollar of capital is a dollar not working in the economy, which is total bullshit, total nonsense. Okay, this is a lobbyist. And then they say the rule will keep billions out of the economy. Don't touch me because you're keeping the money away from the economy. Just as much nonsense, same playbook. And very recently, you had a headline that still alludes to this language. In fact, I think Mr. Véron was quoted in this piece, and so was I. And I was very mad with the title of this. Regulators free up $500 billion of capital for lenders to fight the virus storm. This few months ago in the Financial Times. By relaxing capital requirements, central bankers have aimed to keep credit flowing to businesses, households, and mitigate the economic turmoil. They freed up capital, so it's like it's in a cage somewhere, and you're going to set it free so it can do all these things for us. Completely nonsense. So now it can lever up to 10 times more of that and have loans at $5 trillion to the economy. This is an incredibly misleading language. All this is saying is we're going to stop worrying about the risk. We're going to just pour supports into the system, and they'll owe us, but we'll worry about it later. And let's hope that they do something good with it for us. That's what's going on. We're going to forbear and we're going to forgive and we're not going to worry about the zombies anywhere. They did stop the dividends, which in the US they didn't even do. That depletes the green stuff. But then, of course, you can build more and more towers of red stuff so that they can somehow pass that on. And so one of the things going on is the good word credit, which is a very positive word in the English language anyway. Credit's at the end of a movie and all that. You use the word credit, you don't use the word debt. That in some languages is not a positive word. I think in German it's not a positive word. So you don't use that word, but it's really the same. I give you credit, meaning I give you a loan and then you owe me, okay? So that's, is that always good? Well, here's Paul Volcker saying just about whatever anybody proposes, the banks will always claim it will restrict credit and harm the economy. It's all bullshit, is what he said. And now I need some hours to really unpack the bullshit, but it is all wrong. And he said this to a senator, and it's quoted in a book called Payoff: Why Wall Street Always Wins. Came out right after our book. So the issue is, how do you make good investment happen? Which investments are really good? How best to fund them? Why are we subsidizing debt when we can fund things more directly, or by subsidizing equity, or making sure it's funded with equity? And do heavily indebted corporations make good decisions, including heavily indebted banks? So you can now bail out the whole economy. Here's Martin Wolf in a review of our books about what's special about banks. Banks are not special except for what they get allowed to get away with. So this is basically the point of our book. The model is intellectually bankrupt. The reason this is not more widely accepted, bankers are too influential, and the economics of it are so widely misunderstood. So it's a mix of confusion and politics. So the politics is terrible. Banks are where the money is. That's what the robber said when asked why he robbed the bank. Everybody needs the bank. The guarantees appear free to the politicians. The banks seem like a source of funding, not risk. So let's forget about risk. There are national champions. I can't regulate my bank because you're not regulating your bank. Central banks are covering up for the governments and for the banks altogether, and there's a doom loop, and that's more in Europe, and there's willful ignorance or confusion. I never know what's really going on in people's heads. So the bottom line is banks get away with it, and there are many, many enablers to this system throughout the system, and then in the official sector, including academics as well. And I wrote a paper on it, trying to summarize my 6 years of battle on this issue called It Takes a Village to Maintain a Dangerous Financial System. I have a quote there from a banker telling me that the academics are the problem, and with such friends as the academics, they don't need lobbyists. They do need lobbyists to do the marketing of ideas. They never market my ideas. And as they say, it's difficult to get a man to understand something when his salary depends on not understanding it. This was said about men. It's mostly true for men, but this is, you know, they don't want to understand. So, and this is again what the risk manager told me, with such friends who needs lobbyists. And now they come all the excuses and all the nonsense of the narratives. Everything is good now. The banks are very strong, and now is not the time. There'll be unintended consequences, trade-off. We have a new document after the book that, you know, in the story, The Emperor's New Clothes, the emperor keeps marching even after the kid says the emperor is naked. And so we summarize things, 34 distinct flawed claims that are made that are basically flawed, just as the emperor's clothes didn't have substance. So we debunk, if anybody wants to know, there's level playing field, the success of the banks can rob the countries, they succeed at the expense of other people, they cause a race of requirements. Oh, I already said that. Shadow banking is complicated. And there's also, let's not forget, misconduct, fraud, money laundering. We're not talking about right now the Danske scandal, Deutsche Bank, when employees cooked up their schemes. These have a lot of criminal things, and every time there's a headline about some fine, people who voice concerns are shut up, the people who create all kinds of havoc are succeeding, and there's no punishment. So even the justice system, the executives get bad. So we have bad rules, not just beyond capital regulation. We have subsidies for taxes. We have exemptions from bankruptcy. We have bad disclosure rules. We have, you know, mentioned liquidity coverage ratio. I'm not a big fan of that. I'm not a big fan of other things. And we have immunity to executives. So a lot of these things are the bad rules that enable this system to continue to be reckless. COVID-19. So now I'm going to try to wrap up and get to today. Yeah. Okay.
Madam Admati, if you can come to a conclusion.
Yeah, I have just a few more slides. I have a few more slides. Okay. So we came into this crisis very fragile. Here is Bill White from the BIS, the seeds of the next financial crisis. These are all quotes from the last few months. Unconventional central policy will set the stage for the next crisis. Here's what could really sink the global economy, $19 trillion in risky corporate debt. So in the years between the crises, in those good years, interest rates were very low and corporate debt increased a lot. And this is a warning from the IMF that debt from these countries is at risk of default and could shake the financial system. So now we have governments and central banks responding against, propping up a lot of banks and a lot of corporations. Liquidity supports assets support this. I wrote a letter with hundreds of academics saying, do not bail out corporations, bail out people. I think in Europe they did better, just paying out people who were in lockdown directly rather than give money to corporations. And again, this is the misleading narrative. They're supporting debt, so there's much more debt. So this is the last few months' debt. A lot of corporations issued a lot of debt because the central banks are buying those debts. So they're propping up the corporations, and now too big to fail is the entire financial system. The Fed's market support is staving bankruptcy, may set the economy for longer term pain. Too big to fail, the entire banking sector. In Europe, the ECB is also buying a lot of corporate bonds, and all the plan to move all the bad debt to a bad bank is being floated up again. This is again from the last 2 months, but they don't want to do that. Instead, they keep bailing out. And just last week, the European Central Bank is also buying properties. So now is not the time, is the mantra. Now is not the time to regulate. Now is not time to reform. I love this cartoon. No, Tuesday's out. How about never? Does never work for you? Never is a good time, okay? So you kick the can down the road, you extend and pretend, you don't let the dominoes fail. We don't want a Lehman moment. And here we are. The system is entrenched. We have bad habits. Can this time be different? Or are we going to somehow survive this and say, here is trust me, and behind it, it says, I am lying. So the banker's new clothes is all the emperors keep marching. That's it.
Thank you so much, Madam Admati, for this very interesting introduction. There's a lot of food for thought here. I'm going to jump immediately to our two experts now that I'm sure they can enlighten us on how sometimes through regulations we make, as you said, banks look safer than they actually are. So I'm jumping immediately to Nicolas Véron to talk about the CRR quick fix and the changing in supervision. You have 10 minutes each. I will have to be a bit more strict with the timing.
Sorry about that. I'll mute myself.
No problem, Admati. It was very interesting. No problem at all. Nicolas, the floor is yours.
Thanks very much, and thanks very much to the group and Sven for the invitation and the engagement. I'm very grateful for the opportunity to speak here. It's an honor and privilege. I basically agree with Sven's concern that there is a risk of giving the banks too much leeway in the context of the crisis, even if some of the concerns that drives that are good intentions of saving the system, keeping credit flowing. I basically agree with the political economy analysis of Anat Admati's presentation, and the same with the book she wrote with Martin Hellwig, and I think Martin Hellwig also deserves a lot of credit for his long-standing analysis of the weaknesses of our system. I will have a nuanced assessment, more nuanced maybe than other things we'll hear today, on what has been done so far, and I will also try to say a few things about the outlook. So let me speak about, and I'll be very succinct, so a bit cartoonish, how we came into the pandemic, so the actions that was taken before, the actions since the coronavirus outburst, including the quick fix, and then look ahead to the next steps. So before the pandemic, what did we learn since the outburst of the COVID-19 crisis? I think it's very important to point out that Basel III basically has been vindicated. I mean, Anat and others believe Basel III was not enough, and I'm not going to enter that controversy. What I will say is, thanks God we had Basel III, and Basel III has made a huge difference compared with Basel II or whatever we had before. So we've heard lobbyists from banks throughout the decade of implementation of Basel III telling us it's too much, we're building the dam too high, and this is absolutely not what we have observed. Whether the dam was too low is too early to tell. I'm not sure that's the case, but it certainly wasn't too high. And I think there's a big lesson here, because that gives a lot of credibility to the Basel Committee going forward, including for the implementation of the last stage of Basel III, what the bank lobbyists call Basel IV. But it also deprives the bank lobbyists of a lot of their credibility, because now we know that a lot of what they have been telling us in the past decade was just not apt, and I think there are lessons here. The other thing that has been vindicated is European banking supervision, also known as the SSM. So I think, again, it's early days and it's too early to say the SSM got it right, but, and I'm not going to say that, but I think what we can say is that the SSM has made a big positive difference. And if you look at the actions that have been taken, for example, on dividends, on capital relief, I'll come to that. If we didn't have the SSM, if we had a nationally organized banking supervision as we had 10 years ago, we would have had intractable collective action problems the way we had them 10, 12 years ago. And none of the national authorities would have dared to, for example, put an end to dividends because of the stigma effect, and the same with capital relief. So just by solving the collective action problem of a national supervision in the Eurozone, in a single market, the SSM has made an enormous difference, has enabled us to be much more effective in the response to the crisis, and I think that deserves mention. Now, of course, I'm not going to say everything that was done before the crisis was sufficient or perfect, and I'm particularly mindful of the flaws in our framework for resolution, for deposit insurance, and the fact that the bank sovereign vicious circle is still pretty much intact despite the implementation of the SSM. So if you think of banking union, I think it's a misleading narrative to say banking union was 3 pillars and we did 2, there's 1 missing, which is deposit insurance. Actually, the situation is worse. Banking union was primarily about breaking the bank sovereign vicious circle, and that circle is unbroken, partly because we don't have European deposit insurance, but also partly because our resolution framework is not working as intended by the BRD legislators, and also because of things that are not captured by the 3-pillar narrative, such as concentrated sovereign exposures, which really have to be tackled if we want a resilient system. I will also note as a footnote, and I'll come back to this, that as I said, Basel III has been vindicated, but the EU is not fully compliant with Basel III. And I think there has been a lot of debate in the European Parliament about this, of course, but I would encourage the European Parliament and the EU institutions more generally to revise their non-compliance items with Basel III, because I don't think they're really justified. So now let me move on to the actions since the coronavirus outburst. And I will basically say they're good. They're basically what needed to be done given the context. You think of putting an end to buybacks and dividends, including what has been done about additional tier 1 and COCOs. I'm not entering the debate with Anat whether this additional tier 1 makes sense or not. I'm just saying we have it. Given that we have it, was it the right stance to do what has been done? I would say yes, and I would add, we compare favorably with the US, because the US authorities know that they should have asked the bank to stop paying dividends, but they haven't done that for political reasons, and I think it makes Europe look good in comparison. Capital relief, I think it was entirely appropriate to release some of the buffers as the authorities did, the contracyclical buffers and some of the Pillar 2 stuff. This has been done very early in the crisis by the ECB. Goes back to my point about the SSM. I think it was absolutely the right thing to do. It's not regulatory forbearance. It was a very transparent process. It was not a way to give banks a free pass, and I think it was a very proportionate and actually bold gesture that was done very quickly. And here again, it compares favorably with the US. In similar terms, the US, of course, never implemented countercyclical buffers and was less clear, I think, in its capital relief action than the ECB was. Compliance with global standards, we can discuss whether that's important. I believe that's important. I think it's important for the EU, especially if we believe in, geopolitical commission and all that, to be compliant with global standards. Here again, I think we entered the crisis less compliant than the US because of our departures from Basel III, which I think should be corrected. But in the reaction to the crisis, we've performed better than the US because we've been able to react to the crisis without massive breaches of global standards. And that's true for IFRS 9 implementation. So accounting, and here the US Congress did something very stupid and destructive, I think, on expected credit loss provisioning, which hasn't been reciprocated in Europe. And more importantly, on Basel, the US exempted sovereign exposures from the leverage ratio, which I think is very dangerous. And happily for me and for many observers, Europe hasn't done that, even after the US did it, including in the discussion of the CRR quick fix. So coming to the CRR quick fix, I'm not going to spend much time. We'll come back, I guess, in the Q&A, but I think it was proportionate. It was a no-nonsense proposal from the Commission. It's being adopted more or less as proposed with some amendments. Some of the amendments are useful, others less so, but generally speaking, I think it shows restraint, including in this crucial matter of the leverage ratio and sovereign exposures inclusion, and I commend both the European Commission and the Parliament for that. Looking ahead and being aware of time, the big question is whether banks have enough capital to withstand the shock of the pandemic and its consequences. European banking supervisors at the ECB use this metaphor, which I think is good, of crossing the desert. Do we have enough fuel to cross the desert? Certainly the emphasis on capital conservation, including in the dividend suspension, was the right one for that. I think that question in a way is not a current question. I mean, it's clear that right now the markets give European banks the benefit of the doubt by and large. Rating agencies have a stable outlook. And in a way that's good news, because right now we have a very important discussion going on fiscal actions, multilateral financial frameworks, the Commission's proposal for a recovery and resolution facility. That's where the action is right now. As for the banks, they have enough capital for now. Maybe they won't have enough capital a year from now, but I think this is a slow-moving discussion, and it's good to monitor it. to keep in mind the lessons from previous crises, that, if there is a problem, it's better to act early, it's better to act system-wide, it's better to act with recapitalization, not just bad banks. It's crucial in the Eurozone context to act against the doom loop, the bank sovereign vicious circle. So all this remains true, and that may point to instruments like, ESM direct precautionary recapitalization and the like. But I think the good news is we have time to think about it. This risk is not materializing right now. And so I think there's an appropriate focus of the public policy debate right now on the fiscal stuff, where we're having very active discussions with important breakthroughs. Finally, to conclude, beyond that horizon, what is the important thing for reform? And I will just emphasize two things. One, fundamental is completing the banking union. The job that has been done is not enough. The job has to be finished. That means tackling a resolution framework that works, a European deposit insurance that's part of it, and addressing concentration sovereign exposure. This is critical. It's about the survival of the euro long term. You shouldn't drop your eyes from that ball. The one thing I would add, and Anat has alluded to it, is AML reform. There's policy momentum to create a credible framework in the European Union for anti-money laundering supervision. I think the European Commission is going a bit slow on this given the policy momentum. I think it's important that Parliament would make sure that this happens, because we need centralized AML supervision with, of course, a role for national authorities, but this is really important to implement in the next 2 years. Thank you very much.
Thank you so much, Nicolas, and thanks so much for sticking within the time you were given. And now we jump immediately to Mr. Thierry Philipponnat to talk about the financial regulation and consumer protection. Mr. Philipponnat, the floor is yours.
Thank you very much. Great pleasure for me to be with you today and to share a few thoughts. I will try to be as good as Nicolas on sticking on time. I have to say that listening to Nicolas, I was thinking, if you had asked me to speak about what he spoke about, I would have said things that are very similar. And what's really striking on the topic you asked me to address is that the situation is very, very different. Because on the topic of financial regulation and consumer protection, the main point, in my view, is that the link between the COVID crisis and the measures taken, we just heard about the banking measures, or the measures regarding banking, and the measures that are contemplated. They've not been announced yet. I mean, they're only, in that draft discussion note that's been circulating for 2 or 3 weeks now. So they're not official, but they're widely discussed and spread. In my view, have very little to do with the COVID crisis. That's the very first thing I wanted to say. Because when you read the title, targeted amendments to securities market regulation to facilitate economic recovery post-COVID-19 crisis, who would not agree with that? I mean, facilitate investment, allow for recapitalization of European companies, allow for newcomers to tap the market. Who would not agree with that? So, the headline is fine. But it strikes me that the reality, when you go into the list, and just to assure you, this is a long list of probably up to 25 or 30 different measures. We clearly don't have the time to go into every single measure. So I will keep it, as sort of the headlines and the logic. But the relationship with what's happening with this crisis is, to be very polite, not obvious. In my view, this list is like a lobbyist dream. Thanks to COVID, like it's Christmas in June this year. It clearly reflects the saying, never lose the opportunity of a good crisis. And when on the banking package, there are some arguments to say, look, there was a rationale for doing what has been proposed. You can argue, you can put nuances, you can say this or that, but there was a rationale. Here it's like, let's take the opportunity to, the door is open, let's go for it. I would argue that this is true not only of measures, and I'm going to go very quickly through a list of measures which I think are for some of them not interesting, and for some of them completely unacceptable, in my view, my analysis. But even for those measures that arguably could be reasonable measures, here again, what's the link with this crisis? A very important point that has been forgotten in the measures proposed, and you'll see that this will be like the thread of what I'm going to be addressing now, is that finance is about trust. And I have a real problem with the fact that we are inferring with these measures that a world with less financial regulation and less consumer protection will be better for economic development and prosperity. What have we learned in the past 12 years, over the past 12 years? Have we done everything we've done for nothing? I mean, finance is about trust between citizens, consumers, and institutions. If we lose that, the whole thing collapses. And this is really the main problem I have with the measures proposed. So very concretely, 4 blocks of measures proposed and 4 different pieces of regulation. The first one I'll go very, very quickly over because we don't have the time, is the so-called prospectus regulation. Basically, prospectus regulation is about bringing the necessary information to investors so that they can take informed decisions. And here the proposed measures are all about bringing less information to investors on the basis that it will be easier for issuers and companies to tap the markets and to raise capital. Nothing could be further from the truth. If companies have difficulties raising capital today, it is not because they are asked to give too much information. I'm not saying prospectus regulation is perfect. You can always argue about this or that, and you can amend, this detail, that detail. But asserting that it is because there's too much information in that prospectus regulation given to investors that companies don't raise enough capital is simply wrong. So using this opportunity to relax that, frankly, I have a very serious problem with. If we go on something which is very important, which is directive on markets and financial instruments, so-called MiFID regulation. MiFID is a huge piece of regulation. So here again, I'm just going to pick 3 or 4 examples, probably 3, to illustrate my point. One thing that really struck me, and I think this is so telling, as an illustration of what I was saying, never lose the opportunity of good crisis, is that there is a provision saying that, or a proposed reform, saying that professional investors should be allowed to opt out of telephone recordings for all the dealings with their advisor. What does that mean? That means that, let me put it this way. Let me tell you what those telephone recordings are for. Those telephone recordings are meant to enable supervisors to catch the cheaters and the insider dealers. So by saying we should reform that to help the recovery, are we implying that we need the cheaters and the insider dealers to have a booming economy, to have a prosperous economy? Is cheating or insider dealing good for the economy? I mean, I simply don't understand that. I mean, this is a typical illustration of something which is frankly absurd. Commodities trading. There's an assertion in that note saying that well-functioning and liquidity commodity markets are key for the revival of EU economies after the crisis. Well, that could be debated, but clearly the proposal to change position limits on commodity markets on the basis that it would allow farmers, producers, and manufacturers to better hedge their position and their risk is just, in the very best of cases, misleading. Position limits are anti-manipulation measures, because when you don't have position limits, basically some traders can manipulate the market. How does this benefit to farmers? Do farmers want prices to be manipulated? Well, I stop here. Of course, you can, here again, always argue about the best way to calibrate the position limits, and there are endless, very technical debates on that. But saying that position limits will help the recovery leads us nowhere. And in particular, on the commodities market issue, the proposal to exclude energy markets from position limits is something that, to me, sounds really surreal in the context of global warming and climate change that we have today, because obviously energy prices are a key factor to determine the right policy measures in terms of energy consumption and transition to a different world. And saying that we should exclude power contracts from position limits frankly makes no sense. Market abuse regulation, very, very quickly. I'll just take one example because I'm realizing I'm already too long. So very simple example. There's a proposal on managers' transactions, managers of listed companies, saying that we should raise the threshold for managers to report that transaction, as it is too time-consuming and it is too burdensome. So here again, are we saying that basically making it easier for, in this instance, managers to cheat, to do insider dealing, will help the recovery? I think I'll stop here, but you know what I think. The last example I want to concentrate on, and I'll be very quick on this, is the case of securitization. From an economic standpoint, this may be the most important measure that I feel should be really fought against. Basically, the proposal is to make so-called synthetic securitization easier and to relax the rules on those securitization. Just for the non-technicians, synthetic securitizations are by nature bespoke, they are by nature complex, and they are by nature non-transparent. Contrary to ordinary securitization transactions, the assets are not loans, but derivative contracts offering the originator, i.e. the bank of the transaction, a credit protection in exchange for remuneration paid to investors. Those credit protections are by nature, by definition, complex, both legally and financially. And they are, very importantly, impossible to monitor in a real time by supervisors. And therefore, saying that we can put a label, an STS, simple, STS means simple, transparent, and standardized label on synthetic securitization is a complete nonsense. Moreover, the benefit to the economy of those transactions is exactly non-existent. Witness the fact that the banks, and of course the note says it will be good for the SMEs and everything, because SME is always a catchword that attracts sympathy, and we know the game. But the reality is that the banks doing synthetic securitization are not the banks lending to SMEs. So when you think about it, you realize that this is just rhetoric, because basically it's the large banks who do that sort of financial engineering transactions, when lending to SMEs is done by small to medium banks. So I would have many, many more things to say, but I'm conscious of time, so happy to extend further if you want me. If you tell me you have 3 more minutes, I will keep on going, but otherwise I'll just stop here and maybe respond to questions. But really, my summary is, please let us stick to the economic reality and let us not leave the door open to unwinding everything we worked on over the past 10 years.
Thank you so much for Mr. Philipponnat for this intervention. I think we have a lot of food for thought. Now I will suggest maybe that we will jump immediately to the reactions from NGOs and activists to all this, to bring their ideas, and then we'll have the session of questions and answers at the very end. So we will be able to reflect on everything. So this second part will be moderated by Sven, so I will give him immediately the floor. Sven, all yours.
Thank you, Ernest. I would like to suggest to have now the first reactions, also in order to move towards the questions and answers session. And I've seen already quite a number of written questions in particular. I remind you, if you want to speak, please use the hand button. Well, now it's a privilege, and I make it a habit to always start with my former colleague, Molly Scott Cato, because she is not a colleague anymore, not because the citizens didn't elect her. She was, of course, elected to the European Parliament, and with this, of course, to the Economic and Monetary Affairs Committee, but she was forced out of the Parliament. Near violence had to be used to get her out. Molly, what's your view on these developments, on what we have been building together?
Thank you very much, Sven. You're always very kind, and thank you for reminding me that I was ejected and not rejected by the citizenry, which makes me feel a little bit better, but not much. So I am very aware of the fact that when I was inside the Parliament, I benefited from a lot of expert advice, and now I sit at home with my computer. So I feel a real gulf between what you're discussing and where I am. But in a sense, that's the gulf we need to bridge if we're going to mobilize citizens, I think, to be more engaged in this policy. And that was always a problem for us as MEPs. I mean, having just seen what you sent and reflected on this from where I am, I see exactly what Thierry said, which is, the best slogan is never waste a good crisis. And to be honest, that is exactly what I would have expected the financial industry to do, because during my time as an MEP, as you know, we were constantly under pressure from lobbyists to water down the regulation, which as Greens we already felt was too weak. And I've always felt that citizens bear too much of the burden of the risk-taking of banks, and to enhance that amount of risk burden for citizens at a time when they will actually be carrying the load of the economic impact of COVID-19 just seems to me entirely wrong. And I listened to Nicolas, and obviously he knows a lot more about the detail of these policies than I do. But from first principles, I just find it hard to understand in a situation where banks will be carrying non-performing loans because of COVID impacts on the economy, how it makes sense in that context to reduce the credit requirements of those banks. I just, as a person, as a citizen, I find that hard to understand. I think everybody's approved of the fact that there are conditions saying that banks should not be paying dividends. I hope bonuses as well. Perhaps that's just the Greens. But for me, what we should be doing is imposing much stronger conditions on bank lending and on banks to ensure that the building back of the economy after COVID is consistent with sustainability. I think I see this as an opportunity for the economy, but also for finance, to make sure that we're heading in the right direction, because COVID has been an appalling crisis that's caused thousands of deaths, particularly, sadly, where it's been mismanaged, like the UK. But the climate crisis will cause many more deaths, and we need to use this crisis to build forward in terms of making sure that we invest for sustainability. Obviously, we're having vast amounts of quantitatively eased money as well, and my former colleagues will know that my focus, one of my real pressure points as an MEP, was to say that if you're creating quantitatively eased money, you have to ensure that it is spent in a direction that benefits the citizens, and you have a right to put social and environmental conditions on that, and certainly not, as we've seen in the UK, money created by the Bank of England given to aviation companies and oil companies and BASF actually as well, German chemical companies and Japanese car companies. So we're creating money that should belong to British citizens and giving it to dirty global corporations. And also I'm a supporter of credit guidance for similar reasons, which is, I think if citizens stand behind banks and bank lending, then we have a right to say how that money should be lent to benefit the economy. So I'd be interested to hear what the citizens think about these things, and I'm looking forward to their questions. But to me, when you come to this question, what should we do? I think it's always the same issue, that there's such a gulf between people's everyday experience and the injustices they face in their lives, in their everyday lives, and what happens in the European banking system and the regulation of that system. And the most important thing we always have to do is to try and develop those links and bring people who hold the banking system together and whose work makes our economy function, give them the tools to understand what's going on. And Maybe we need institutions that do that job better. Certainly in the UK, we don't have very many organisations that try to do that. So I observe that coming out of the COVID-19 crisis, people are enraged about injustice. It's quite surprising. It feels to me, maybe this is again just the UK, but it feels to me people are more determined to say we shouldn't have the wealthy coming out of this better off and the poor bearing the costs of COVID. And it feels even stronger than it did in 2007-2008, which I find really intriguing and hard to explain. But what we have to do as politicians, I think, is connect that real determination to have strong community and social justice to what you're doing with the banking regulation. And to me, that was a challenge during my time as an MEP, and I think it continues to be a challenge.
Thank you, Molly. As always, spot on. And of course, I forgot to say that before your life as an MEP, you were, of course, a professor of green economics. And I, as Vitor just switched on his video, I take advantage of that to ask him for his quick reaction. Vitor is, of course, working at the Brussels office of Transparency International on integrity issues. So what's your view on the current developments around finance and the corona crisis? Vitor, the floor is yours.
Good afternoon. Thank you very much for the invitation to this excellent webinar. Actually, I would like to take a small step to the side. I think several of the speakers mentioned the role and the influence of lobbyists in their presentations. And in my view, the discussion today clearly shows the existing long-term issues in terms of lobbying at EU level. And I want to talk about these issues because if they're not solved, I think it will be extremely damaging to the EU and the citizens themselves. Now, I think it's a given that the governments and the institutions are attempting to alleviate the suffering of people and businesses that has been caused by the coronavirus. I think the billions of euros in help that are being discussed are proof of that. But I think it's also a given that many of the businesses and individuals will attempt to use these extreme conditions to their own benefit, whether it is to attempt to postpone legislative initiatives or soften political or policy goals or increase financial support to their economic sector or ask for deregulation, so on. The fact is that the EU institutions are now more than ever a target of lobby activities because there's so much at stake. The quarantine didn't change that. Now, I don't think this is bad per se. I'm a lobbyist myself on integrity, accountability, anti-corruption issues. I think every person has the right to give their say on measures that can impact their lives or their businesses, but there is a right way to do it. I think from the point of view of Transparency International, when we look at the current system, on lobby transparency at EU level, there are three main issues. So the first, and speaking to you, I think this, I should mention this as the first, it fails to adequately protect decision makers. Why? Because the system right now is voluntary. There's no obligation to register. And many of the entries have questionable quality. In the annual report that the Secretariat of the Register published in 2018, of the almost 4,000 entries that they made a random check on, only 48% were deemed satisfactory. I take a second to think about this, less than half of them. And I think this raises a major question, which is, are lobby organizations that go to Parliament and lobbyists, are they who they say they are? If a policymaker meets a lobbyist, they need to be sure that the lobbyist they have in front of them represents the interests they say they do. The second point is a serious lack of information on the lobby activities that are happening right now. And my question to you and to the people that are watching is, how can citizens participate in the democratic life of the Union, as it is in the treaty, if they are unable to know what is happening? At the council level, there is no information on the lobbying targeting the permanent representations of member states. The Commission does publish the lobby meetings of its top officials, but that is just the tip of the iceberg. And just a few weeks ago, we heard that they do not publish or were not publishing the meetings that did not have a video. So if my video is now off, do my words matter less? And on the Parliament, the Transparency International research, which is actually being published in the coming weeks, has found that less than a third of MEPs publish meetings with lobbyists. And the third point is that the current negotiations for a mandatory lobby register are dragging on for years and years, and the institutions just show an unwillingness to tackle the truly problematic issues. So the council says that the permanent representations are not EU institutions, so they don't have to abide by any rules on lobby transparency. The Parliament has simply readopted a mandate that is years old, and I would not say that it's terribly ambitious on reforms when it concerns itself. And not only that, it also provides no rules for meeting unregistered lobbyists. And for the Commission, it has completely removed the indirect lobbying from the definition. Now, if you think about all of the paid advertisement that you saw around Brussels when it was the discussions around copyrights, I would say that is very prevalent as well. So I think all of these three issues show that, quite honestly, the lobby transparency and the impact that lobbyists have is very far from being achieved. And I think it's extremely worrying considering the times we live in. We need to ensure that the input given by lobbyists is done openly, and that is everyone has an equal access to policymakers, and that right now is not the case. Our research showed that of the 2%, the top organizations in the register with the most meetings with the European Commission, these 2% constitute a third of all lobby meetings and a fourth of the lobby expenditure at EU level. And the citizens need to be able, sorry?
May I give you a time signal?
Yes. And I think that citizens need to be able to see who is influencing, and is up to the institutions to ensure that that happens. As Professor Admati mentioned in her presentation, transparency and accountability are key. I think that is true for the banking and financial sectors, but also for EU lobbying activities in general. I think with so much at stake, it's time to do it now.
Thank you. And I will immediately hand over the floor to Myriam for her reaction. Myriam Vander Stichele is an experienced researcher from the NGO community around finance. She has talked about financialization well before the financial crisis of 2007 and 8. We know each other actually already from the old days before I entered the Parliament, and was talking about the financial sector as she did well before anybody was interested in. So, and now we saw years of at least some regulation. We heard it didn't go as far as we wanted to go. Now it's already going into the other direction. But how do you see what's happening in Corona times with the financial sector and its regulation? Myriam, I'm curious to listening to you. She is working for SOMO, which is a Dutch-based NGO concentrating on transnational corporations. Please, Myriam, you have the floor.
Yes, thank you. You know, when I was reading the proposals, it's was for me like the EC seems to be speaking with two completely incoherent voices. Because there is absolutely no conditionality on making sure that it is going to benefit, let's say, the economy or citizens, let alone, you know, kind of a just transition. Because on the one hand, you know, they talk about deregulation, and there is no condition attached. And at the same time, also you hear voices saying, if there is a recovery, it has to be aligned with the Green Deal, it has to be inclusive, and it has to protect citizen interests. So for me, it's staggering, and I think that's a point we really have to show. And I think if you just quickly looked at it, there could be some tweaks and quick fixes. For instance, well, in one of the papers, the Commission was saying, well, the banks have to continue to have this kind of standards about knowing your customer. So at least, for instance, the Commission could have said, you have to include whether that company would be operating in line with climate mitigation efforts. Or what for me is very concerned is that there are all these different capital relief and flexibility measures that we heard about, and also non-performing loans, for instance, they should not apply to fossil fuel-based industries, because these might be stranded assets. They will kind of be contrary to the climate deal that everybody's talking about. Also, just a very kind of quick fix on the prospectus. Just there should be added information in how far that company is willing to align with the Paris Agreement or with the SDGs. These are just kind of tweaks, but there's nothing about it. And I think, as far as I can see, there's actually no legal obligation in the proposals that dividend payments should be stopped, and certainly until the buffers are completed again. Even for the bonuses, I think, but also there should be never share buybacks. There are calculations that, for instance, for the last 10 years, the biggest banks have bought back shares for about 1.5 trillion. This is kind of misallocation of capital, I would say. And I would say it should not only apply to banks, but it should also be on insurance companies, and especially, I would say, on what is called the alternative investment funds, the hedge funds, private equity, etc., because they have been always trying to have extremely high benefits and kind of returning it to some of their investors. So I really don't see kind of real guarantees that this will benefit households and SMEs. And for instance, with QE, what we saw is that a lot of the capital was flowing out of the EU because there are no capital controls. I can speak about what because of trade agreements and so on. So as we've just said, unfortunately, what I see in the measures is what I've heard from years from lobbyists, and that's what people have been saying. I'm really concerned about the terminology. It's a regulatory burden that we are taking away, rather than a language of regulations are there for public interest. If there was a mistake, probably that could be corrected. But just for instance, on the proposals on the MiFID reform, what Thierry was talking about, that there should be less limits on speculators that would participate in new oil, gas, and metal commodity derivatives markets. Why should we allow kind of fossil fuel industries to be able to hedge much better? They really there is a real need to make sure that the problems are being felt there. They should not be able to be hedged. And also, what I've seen is there was still a lot of speculation that was happening on the oil prices, and some of these speculators were able to get millions of profits out of it. So there's still a little problem. And basically, if ever we would need kind of better derivatives markets, it would be on the wheat market, because we don't have them enough for farmers. There's nothing on farmers actually there in the proposals, if you look at the details. And the same with exemption of financial players. There's absolutely no guarantee that they will not be able to speculate. One other issue that we've been talking about was this synthetic securitization, which absolutely doesn't have anything to have simple and transparent and standardized securitization. But the main worry there is that it will transfer the risks to where we don't know. And that's exactly what happened in the last crisis. So I would say, to finalize, we need to simplify. I mean, there's systemic issues that have not been addressed, because some of these measures are actually the supervisors are saying, well, we can't monitor anyway. I mean, that's a real problem. We really should have simpler structures, simpler products that would also support the supervision, but also it would allow not to have this misallocation of capital, as I call them, because there's too much speculation with high-frequency traders, day traders, and so on, and they don't kind of reorient funds to the economy, let alone to a just transition. And the other thing is that basically these measures will allow more debt, and we have to avoid more debt. So why not having measures that we allow to have much more taxes being paid by those who benefited from kind of the lax regime on the capital market regime. So I think the wealth taxes should be something that would help to avoid kind of more debt to be happening. Just don't forget that there were figures that, especially for the US, but kind of 1% of the top household in the US are owning 46, or let's say half of the shares and bonds in the world. So they are kind of benefiting most of it. So if we will relax these rules and it will benefit again, the capital owners, that will mean we will increase inequality and we have to decrease it. So that would where I would end. Thanks.
Thank you, Myriam. And finally, I would like to give the floor to Guillaume Prache. He's the boss, I would say, or the director or CEO, however you call it, of Better Finance, representing the national organizations of investors, and therefore, so to say, the buy side on the of the stock exchanges, and beyond. Guillaume, what do you make of the recent proposals?
Good afternoon, good evening, I should say. And in fact, it's a very appropriate and timely webinar on financial deregulation. Congratulations, and thank you very much to give Better Finance, which is the European Federation of Investors and Financial Services Users, so by far not only the stock exchanges, to have an opportunity to quickly share our analysis and proposals. And in fact, I'm going to add a lot to your plates, especially Vitor's and Myriam's. In fact, we do observe a quite strong return of the EU regulatory capture by the financial industry to pre-2008 financial crisis levels. And EU authorities nowadays seem to often go back to the good old ways of doing business that they had rightly decided to give up in 2009. And I'd like to give you very quickly 6 very serious cases on top of what has been discussed, with which I agree. First thing, on the note we refer to, there was these 2 big pieces of regulations missing, where the financial industry is putting a lot of gunfire. It's the Shareholders' Rights Directive 2. Very recently, they tried to postpone by 12 months the implementation of shareholders' rights. I put as a link in the chat the press release we've done. We gathered 20 organizations of savers and investors, and for now, we convinced the Commission to say to the financial powerhouses, no way, do not use COVID-19 as an excuse. You have to implement by next September, for now. But I will hope the Parliament will back us on that. Second example, and Sven, you mentioned today that there was the report of the high-level forum on the Capital Market Union, and I was one member of this forum, but there was a heavy over-representation, is a mild understatement, of financial intermediaries. There were 28 members. We were 2 consumers and savers, me and Véron. and I counted at least 18 financial intermediaries. We are in the CMU, which is supposed to deal with issuers of the real economy and investors of the real economy. And the majority is financial intermediaries, including 6 mega large US financial institutions. For example, to discuss the LTIF, the European Long-Term Investment Fund, I was asked to discuss with someone from the BlackRock staff, not even the BlackRock HLF member, but one of his staff members. That's a second thing, and I will also put the link to the press release we issued today on this, so you will have all the data. Third example, CSDR, the Central Securities Depositories Regulation, which is also not on the list. There also, at the HLF-CMU, I had to discuss alone with 4 mega banks that they wanted, again, a postponement of the introduction of discipline measures when settlement fails. They wanted not only a further deadline, the Commission just granted one last month on the implementation of these settlement discipline measures, but they wanted it also optional. For now also, I blocked it, but I hope also the Parliament will be vigilant. The fourth thing I must tell you about is that the EU support program to enhance the involvement of financial services users into EU policymaking is a 4-year program that is ending this year. The Commission was supposed to table a new regulation proposal to keep this essential program. Nothing has happened, and in 6 months, it may well be that better finance will be dead, and next time you will have no one raising against the financial industry when it pushes against shareholders' rights, as it just did with the trying to postpone shareholders' right directive 2. Fifth point, and I have only two left, is to give and also to add to the plate of Transparency International. We were invited last week by the Commission for a financial roundtable on the relief measures for COVID-19. So not only we were outnumbered as users, NGOs by the industry, but that's the same. It's not as bad as in the HLF-CMU, but that was also the case. But more shocking, you had 4 observers. The 3 ESAs, so banking, insurance, securities market, no problem. And the European Retail Financial Forum. So this also, I will copy you the link to be short. And on the chat box. The name sounds good, and the Commission is putting it together with the 3 ESAs. In fact, it is a group of banks. And in fact, I must say that they routinely get MEPs talking to their events, whereas we are many times struggling to get even one to our international conference. Last example, which touches directly the European Parliament, and there also I will put the link so I can be extremely quick again. It is, just trying to be agile there, it's not easy sometimes. Here I am. It is another forum, beware of forums. It is called the European Parliamentary Financial Services Forum. This is inside the Parliament. It includes parliamentaries, MEPs. We NGOs, user-side NGOs, had been for many years invited as observer speakers. So when you would have 5, 6, 7 speakers of the industry inside the European Parliament, you would have at least one NGO, user-side NGO, who could at least give a different tone. We have been expelled last year, all of us, from this EPFSF, and now they provide training webinars to MEPs solely provided by finance industry lobbyists. I have many more cases like this, but I will stop there for the time reason. Thank you.
Guillaume, thank you very much. Even if this was not what you like for dinner, and but it was very much telling. Several of these things, of course, you will hear from me to follow up, but it's we received questions from our participants, and one is very similar to what I would have raised. It goes to Nicolas, and I would read it directly. The SSM, so the Single Supervisory Mechanism, recommended banks to suspend dividend share buybacks. Additionally, the European Banking Authority recommended to be cautious with bonuses. Automatic restrictions on distributions will not apply in the near future because capital requirements have been reduced and are about to be reduced further. Why do we allow banks to continue paying out AT1 coupons? Why do we protect AT1 investors? Who are they? Why are politicians afraid of touching AT1 instruments whose risk premia have been artificially low in the recent past? Banks not being able to afford risk-adequate funding costs are zombie banks and should exit the market. No? So this question refers, of course, also to the fact that our proposal to make restrictions also on the payout of AT1 instruments failed in the European Parliament on Monday and Tuesday. So then there's a question to Anat by Connie Berger. Do you agree about the need of a healthy separation between the financial public sector and money and the private commercial banks, creating most of the money and debt? If so, what kind of steps do you suggest? So, and then there is a question by Colette Sternberg. I'll translate from the German original. So far, all statements are only substantiated with reference to major banks. This is fully understandable, but in the credit industry, there are many smaller banks. Small and medium-sized banks in particular are very active in supporting small and medium-sized businesses in times of pandemic. Deregulation for these banks should not be categorically rejected just because large banks have repeatedly become scandalous. So then a question by Annette Wolf. Is there no possibility to make the decision makers of the banks liable for losses with their own assets? I think that would help. I think that's a typical question going to Anat, but perhaps also Thierry or Nicolas want to come in on this. So, and then a last question by Peter Claassen, again translated from the German original, on dividend distribution. The background is that weak banks, especially in Southern Europe, should not be stigmatized in order to avoid additional problems such as deposit withdrawal. The distinction between credit-worthy banks that are allowed to pay dividends and other banks that are not allowed to do so was avoided. To proceed to a dubious recommendation with a massive legal threat of bank supervisory measures if this is not followed. How is this to be assessed in a state of a rule of law? So basically what he refers to is, how can you ask a well-capitalized bank to stop distributions only to treat everybody equal? Perhaps this is could also go to Nicolas, but feel free to comment, and also to comment of what you heard from the other participants. I suggest we turn around the order. I start with Thierry, and perhaps he can also say a word whether FinanceWatch has the same problem with commission funding as was reported by Better Finance. Nicolas, and then Anat could make again the big picture. Thierry, S'il te plaît.
Thank you, Sven. Well, there's so many topics that it's going to be difficult to be quick, but certainly on the question, there was that question which I find very interesting on the liability of financial institutions managers and what should we do there. And I feel that there are two dimensions to this. There's the liability on their personal assets, and there is the personal responsibility from a legal standpoint. Clearly, when we moved, and we collectively, when society moved, the legal structure of banks from partnerships to limited liability structures, by definition, the managers and the owners had limited liability. So, sorry for stating the obvious, but this is really a question of organization of the entire system. And that is something we should reflect on. I mean, many people, certainly when we were all doing that 10 years ago, when we discussed on reforming the banking system, many voices said, look, put personal, asset responsibility on bank managers and owners, and it will make a difference, because otherwise, at the end of the day, you create moral hazard. And moral hazard is one of the biggest problems in our financial system, and it exists at all levels. It exists at the level of a trader, it exists at the level of a bank manager, it exists with banks vis-a-vis society in general, and that is a big problem. There's another dimension to that liability of the managers of financial institutions, which is the legal personal responsibility. I spoke too briefly about the market abuse regulation earlier, but I remember very well, I'm sure Sven, you remember that, and quite a few people around this table, if I can say table, when we discussed market abuse regulation 2012, 2013, it was adopted in 2014, if I remember well. There was a big discussion about how far do you go in the responsibility of bank managers? Because if there is market abuse, market manipulation within a bank, of course there's the person who did it, but what about the manager? Should the manager be responsible? And so we at FinanceWatch pushed very hard to say, look, if you're the manager, you're responsible for what the person does. But that didn't go anywhere. So there's a big question of personal responsibility, because at the end of the day, as long as human beings are not responsible, you don't stop the real thing, because here again, going back to moral hazard, if it works, it's for you. If it doesn't work, it's not for you. Why bother? So this question of liability, I'm not saying I'm resolving everything, because if you ask me, what are the 2, 3, 4 essential weaknesses of our systems, I think this is one of them. You ask about the funding of FinanceWatch. FinanceWatch is funded about 50%, but that's the case. 50% of its funding comes from EU institutions, but that is called match funding. So we have to raise funding from philanthropic institutions, foundations. The list is on our website. By definition, everything's transparent. You go on our website, you'll find all the information in less than 1 minute. It's 2 clicks and you're there. And then we receive match funding by the...
Guillaume was saying there is a certain threat. I didn't want to have a general of a stop of funding from one particular commission program. And the question was only whether you are exposed to that threat as well.
I'm not aware of it, but
okay.
Having said that, the responsibility for the funding and those sort of issues is with my friend and colleague, SG, but I'm not aware of that.
Okay, thank you. Nicolas, I directed one question to you. I would like to add one for myself. After what I read from you on your reaction to the package after the COVID crisis was a bit different than what I understood today from you. So if I summarize it, I would say anti-cyclical relief is okay for you. Regulatory forbearance, supervisory forbearance is not okay. That was a bit the broad line you took. Unfortunately, this package, which was voted in the parliament and which you roughly applauded in what you were saying before, has as most important element what I would call supervisory forbearance, because with stop of introduction of IFRS 9, you basically do exactly this. You do not account directly the losses. So you were applauding now a package which is just doing what you criticized before in your article. How do you reconcile that contradiction?
Thanks very much, and that's a great question. And actually, I should have gone into more of the detail of the CRR quick fix. You're referring to the way in which the European Union transposed recent decisions of the Basel Committee that allow banks to filter out of their capital calculation the impact of expected loss provisioning, right?
Yeah.
And the short answer is I agree with you. I think this decision by the Basel Committee was unfortunate. It was, I think, prompted as much or perhaps more by US lobbying than by European lobbying, but at the end of the day, it was bank lobbying. As I said, I support adherence to global standards, but in that case, I would have been happy if the European Union had chosen to be super equivalent and not to implement this additional flexibility given to banks in their prudential calculation. So I concur on that. I wouldn't necessarily say it's the most important measure in the package, but that's a minor quibble. I will note, however, that the European Union is sticking to IFRS, it's sticking to IFRS 9, it's sticking to the principle of expected loss provisioning as a financial accounting principle, even so there is some possibility to filter it away from prudential calculation, but the banks that are listed, they have to disclose their financial accounting, and they have IFRS 9 there with the interpretations that the ECB has given in coordination with the ISB. And I think that's in contrast with what the US Congress has done, which is giving an option to US banks not to apply expected loss provisioning this year, which I think was entirely shameful, and the EU has done nothing comparable. The irony being, of course, that many of the banks that lobbied for that in the US have not used that option because of market pressure, but still the option is there and it's bad. So I don't think we have a difference here. I think in that case, the EU should have gone beyond the Basel requirements, modified by the recent decision. But I would still say that generally adhering to the Basel requirement is the minimum, not the maximum, but the minimum that the EU should do. And it does not do that in all areas. So more quickly, there was a question on AT1 coupon and a question on dividends more generally. On the dividend thing, I mean, in a way, you could see it as, you know, a graduated scale, right? You can say no buybacks, then you can say no dividends, which is a higher threshold, which the ECB has done, not the US. Then you can say no AT1 coupon. And then you can say, well, even for debt, which is not AT1, which is 82 or beyond, which is tier 2, sorry, or pure debt, you know, not capital, then you should do a restructuring in order to create a better balance sheet. And I think this is essentially a graduated scale. So the prohibition of buybacks is the no-brainer. I think, frankly, suspending dividend distributions is also a no-brainer, but the US authorities have not come to that conclusion. And I can understand the argument, even so I criticize their decision. And AT1 is one step further, right? So the risk of destabilizing the market at a time of great uncertainty is greater. I haven't done the homework to come to a firm conclusion in terms of recommendation. I certainly wouldn't recommend asking banks to restructure their debt right now voluntarily, because I think that would be highly destabilizing. And AT1 is somewhere in between. So I I wouldn't say I strongly support this. I don't have a very strong view, but I can understand that compared with, the fundamentalism of fighting moral hazard, we're in a difficult moment. We have to care about financial stability. There are trade-offs that are not trivial there. And the ways the ECB has managed that trade-off so far doesn't strike me as scandalous or absurd. I think we should be careful in the current circumstances, not to say, moral hazard is the most important thing. And what Tim Geithner has called Old Testament justice reasoning. I don't approve of every judgment that Tim Geithner has made during the last crisis. I think he has erred very much on the side of bailout. And in some cases, for example, Washington Mutual, where he had a big confrontation with Sheila Bair. Sheila Bair was defending fighting moral hazard, Tim Geithner bailout. I'm on Sheila Bair's side of that one. So again, every situation is a bit different and you need judgment. It's not a one-size-fits-all principle. But I am concerned about financial instability in the current circumstances. On the question about the rule of law, I think, but you may correct me if I'm wrong, that the decision of the ECB to suspend dividends is actually a recommendation. So that's moral suasion. And what that shows is that, to speak the language of the Wire series, the ECB is a figure of authority. And you can contrast that, by the way, to EIOPA, which has made a similar recommendation, but they don't have the same supervisory authorities. The national supervisors are all over the place on this issue for insurers. And we had a very interesting discussion with Gabriel Bernardino earlier today at Bruegel about this. I think it's a bit of an unfortunate situation when you compare that to banking in the Eurozone. One last point very quickly, the question about small banks. There's a temptation to say, big banks bad, small banks good. This is very dangerous, should be resisted, it's just wrong. There are crises that happen through small banks. Small banks are not inherently more virtuous than large banks. Maybe some small banks are, some small banks aren't, some large banks may be virtuous, some large banks aren't. We shouldn't give banks the benefit of the doubt just because they're small. There is a case for proportionality and having different kinds of regulation for small banks than for large banks. But the idea that small banks should be afforded generally more lenient regulation because they're small, this is super dangerous, can lead to the next crisis. I wouldn't condone that. Thank you.
Yeah, thank you, Nicolas. You can't say that to a German, really, yeah? So, but beyond that, I only wanted to say that my remark, we have to wrap up, but...
I just say a small bank with an institutional protection scheme is not a small bank.
Yeah, this you can even say even less to a German. So you are breaking all taboos. So you are.
Nicolas did it.
But the point is, what I was referring to when it came was not the Basel adaptation, but was the slower phase-in of IFRS 9, and which comes now with the package. But that's
and that's bad. I agree with you.
That was the key. But now I really want to stop that debate and go to Anat. I'm curious what you have two big questions on your plate, banking structural reform and the liability of managers. And beyond that, you have listened to our European discussion, and now we are curious what you make of it. Anat.
I have a lot to say, which I don't think I'll have enough time to say. People would start dropping off. So maybe Nicolas and I can continue in public. He kept repeating the comparison of the US. They reminded me of the, apropos lobbying, which was discussed here, I quote the lobbyist saying after the Dodd-Frank reform, which was our mess of a law in 2010 was created, he said when the president signed the Dodd-Frank law act, that was halftime. Halftime, he meant, it's not even a halftime, it's the never-ending game that they play. They'll go now over there, and then they'll go over there, and then they'll go to the international regulators, then they'll go back to the Fed, and then some other person will get elected, and they'll want to repeal and change. So it never changes. It never ends, as you know. The U.S., if you talk, there were a lot of quibbles about who's better. Definitely, it's a disaster in the U.S. and on all banks everywhere. There is no legal problem as far as I can say. It's a completely lame excuse to say that the regulators, prudent regulator, this is a regulated industry, cannot say ahead of an unknown, huge unknown unknowns that you have to distribute any equity at all in dividend form or buybacks for any bank until we know a little bit more. Because the money still belongs to shareholders. You just invest it, and then when the times are better, we'll pay it all out. So there's no problem with retaining. There's no problem. If it's a public bank, it gets reflected in the stock price. You can sell your share, create yourself a dividend. There is no problem, and there shouldn't be a legal problem anywhere on any bank size, okay? Because they are already more indebted than everybody else. To say that the US didn't have counter-cyclical buffers, now we're in the weeds a little bit. The US had higher leverage ratios than Europe, and that's not, you know, whenever in the US they say, oh, you know, look how better we are at Europe. Yes, that's true. We did better along between the crisis, and now you're doing a little bit better on a few of these measures. I agree with a little bit of that, and I'm most outraged by what's going on in the US. Also, you're right that IFRS is a little bit better than GAAP in accounting. But why we're even talking about accounting and why we're talking about ratios, I don't know, because the key is to have not these measures that we keep arguing over, the ratios. Those is why all the gaming goes on, and risk weights and accounting and all of that. So I don't even want to talk about accounting because that's like a set of rules that we use, and we can of course take the effect, but the fact that they have so much impact on what they do is already an indication of how wrong it is, which leads me to the transparency issues. And I agreed with a lot of what Thierry said, which is, and Transparency International, about the opacity. We had the Jobs Act here, what was called to make it easier to go private, to fund innovation, and all these language that's been used. The opacity has not been good from the days of consumer fraud back in the Great Depression that caused all this mayhem, which they led to the creation of the SEC and disclosures, mandated disclosures and all of that. This weakening of disclosure, which has led to more than half of the capital in the US being in private and not public markets, that has been a disaster, and Europe shouldn't follow the US in that. And certainly synthetic securitization has been a disaster as well. So again, please don't follow us. You know, Martin Helwig, my co-author, likes covered bonds more than securitizations. So we can get into that debate. Going to liability very quickly, Thierry already answered some of that. Yes, we had partnerships and people were liable. We have a huge problem with, not just in banking, in all corporations, with executive responsibility. And that's a matter for for the entire legal system and the criminal justice system to redefine what it means to be a responsible officer, and where it is that persistent violations of law, including money laundering and other things, do go all the way to the top when the top tolerated it and benefited from it over all these years. There's a concept of willful blindness, responsible officers. That's my research right now, basic justice in a corporate context. So we're not there. And I'll end with sort of commenting on, you know, Geithner and, you know, moral hazard and all this stuff that was just brought up. No, in our book, and even now, we were not objecting to policymakers doing what they need to be doing. We never objected to that. You know, 10 years have passed and we've been in this battle, and now is not the time, and then the next time is also not the time. So let's be careful. It's, you know, there's moral hazard in crisis and moral crisis out of a crisis. There's moral hazard all the time. It does not mean that you don't do what you need to do, but if you're going to give a bailout to a corporation, you may want to give it by making sure the money goes directly to people, which I think Europe, again, has done better than the US, directly to employees, as opposed to, oh, please don't fire by October and all of that, which they take, issued more debt, fire people anyway. So we have huge unemployment here, which you have avoided. That's good. So I certainly, we can discuss what governments need to be doing, but it's not like the alternative is, you know, ultimate justice and all of that. Geithner was a disaster in the last crisis. Sheila Bair was right, and there's no question there. We agree on that. And I don't jump to ultimate justice, because that's not what the debate should be doing. Policymakers have to do what they need to do at all times. That includes in good times and in bad times. So let's hope that they do more in good times, so we're not in such bad times next time. That's really what it's about. And so thank you to Thierry, thank you for the Greens and all you do. Thank you for Transparency International and a lot of good people everywhere. But we are up against exceeding lobbying that is completely self-interested, and that's where the battle is, which I didn't realize as an academic for the academia until I saw it in my own eyes.
Well, thanks to your entertaining introduction and your entertaining closure, and it was not only entertaining, it was unfortunately extremely knowledgeable. I would like now to hand over to Claude Gruffat, my French good colleague, and listening to what he made of it. We were more than 900 people who registered to that webinar. So, Claude, s'il te plaît.
Bonsoir à toutes et à tous.
Hello to everyone. I will be quite brief in my concluding remarks. First, I would like to thank all of the organizers, the interpreters, the participants, the speakers. I would also like to thank my colleagues for having facilitated this event. And thanks to all of you for having taken part in this conference. As Sven said, 900 today, it's a fantastic number. And it just shows how citizens are interested in that topic. It was a pleasure for us to welcome all of these experts, and I really hope that you enjoyed as much as I did this update on this very complex topic. To finish, I would like to speak about a few things. According to the Register of Transparency of the EU, there are 366 organizations that are registered under finance out of 11,000 that exist. Nicolas Véron was saying it earlier on. We need to control better, to supervise better, but it's complicated. And this army has considerable means. So in 2014, and I apologize, these numbers date a bit, a study was done by an observatory and showed that 120 million euros were spent each year by the finance sector for lobbying in Brussels. Of course, such financial means are a testimony to how these organizations manage to influence the EU agenda. Such a sector has a big influence on the legislations, and that is problematic. What is the goal of this lobbying? It's rather straightforward. It's to dismantle all the rules of good management. They are trying to make sure that the finance sector can develop itself without any limits. Of course, this is harmful to the real lives of people, to the real economy. And this was said many times. We have all seen how this pressure has increased since Donald Trump arrived in power in the US, since he has set himself one mission, and that is to destroy all regulations that were implemented in the wake of the 2009 financial crisis. In the EU, they see this sometimes as a disloyal advantage. And sometimes they would like to go in the same direction in terms of deregulation. So the more we have this virus, this deregulation virus, the further we want to go. And I think this conference was very useful in showing us one thing mainly, is that this new financial deregulation is about to take over. I'm a recent arrival in this parliament, and I ask myself a question. Did we not draw any lessons from 2008?
When will we finally direct finance towards the real economy? When will it really benefit smaller companies? When will we really take into account people? When we will put an end to money laundering, companies that deal into that? Why was the European Central Bank stopped from directly lending to states and companies? And then the taxpayers, will they always have to bail us out and repair all of the harm that has been done by the finance sector? In any case, you can count on my group, on the Greens, on the European Free Alliance at the Parliament. We will be there and we will push forward alternative ideas, the ones that are not mainstream ideas. We will defend the collective interest in the face of this unacceptable threat. And since we are speaking of the real economy and real life, I hope that you will enjoy your meal after this conference, and I hope that you have had a lot of food for thought after this conference. Thank you very much.
Merci beaucoup. Bonne soirée.
Merci à tous et à toutes. Et au revoir. Tschüss.
Au revoir.
Tschüss. Au revoir. Merci.
Merci à tous. Au revoir. Thank you.
See you next time.